being recorded.
Okay, this is going to be video number 6. So we finished last time by discussing several of the practical issues that arise when you're trying to implement or to estimate WACC in practice. So I want to discuss one more here to begin this video, which is the issue of whether you should use book value of debt or market value of debt when estimating WACC. Now, theory is clear. You should use market value of debt, but book value has one advantage, which is that it's immediately available. All I need is financial statements, and I just can add up I can just add up all the face value of all the debt I have, and there we go. That's my stock of debt, which I can put directly into WACC. When interest rate conditions have not changed very much for a particular corporation, and you will remember from earlier in the class that we discussed why interest rates may change for a particular corporation. We have, on the one hand, company specific reasons. The company has become riskier or has become safer. And on the other, we have market conditions. The general level of interest rates may have changed. So if I'm not in that situation, if changes have not been too big, then of course book value is just fine, and it's so much easier to use than market value that's where you're going to want to go. But when interest rates have changed a lot for whatever reason for a particular corporation, then we have to measure market value. So the first thing I want to do is talk about how in practice we would go about measuring the market value of debt. And for that, I'm going to begin by opening my notes over here. I'm going to make them nice and big, and I'm going to go to the very bottom of my notes right here where there is a discussion in section 8 of the market value of debt. So the market value of debt in general is conceptually easy to compute. If you give me any piece of debt, all I have to write is all the payments that are going to be due to me in terms of interest and principal, and I just need to discount those payments at the market rate, at the rate that the market would require from those payments at this particular point in time. So taking here specifically the example of a coupon bond, which is the most common type of bonds that corporations issue. Coupon bonds basically feature interest-only payments until maturity. Here, maturity is going to be capital T, B is balance, R is the contract rate. So I'm going to get coupon payments of BR every period, say every quarter, all the way to maturity. And then at maturity, you're going to have to pay me my entire balance back. Okay, so these two here are all the payments that I'm going to get. I'm going to get capital T coupon payments of size BR, and then one final payment of size B. And all I need to do is to discount this at the market rate. And here I'm using notation R prime for the market rate at a particular point in time. And all you have to do is some geometric sum algebra, which I'm not going to go over here with you in this video, but you should make sure that you agree with my algebra. And if you simplify, you get this formula here. And this formula is a formula that you should believe because it has a lot of natural features. For instance, if R prime is equal to R, in other words, if the market rate is equal to the contract rate, then the market value of debt is going to be equal to B. This is algebra that you should do for yourself. You should check that what I just said is correct, but all we want to do today is put this particular formula, this type of formula to work. And for this, I'm going to go once again to my web page, and I'm going to download some debt data. So this is under teaching. This is called debt data. It's an Excel file that you want to open, just like I'm doing here. And oops, oh, there it is. I thought I had lost it there for a moment. I'm going to enable editing. I'm going to make it nice and big. And so what do we have here? So this is example data of what I may find if I look at a particular corporation. So here we're looking at a corporation that has debt that is going to come due in one of 10 possible maturities. So I have some debt that is whose remaining maturity is 1 year. that debt has face value 100, say, million dollars. The contract rate on that date is 2%. The market rate, however, is 2.5%. Because the contract rate and the market rate are different, the market value of that is going to be different from the book value of that. And let's remember here that what the market rate is telling me is basically if I wanted to sell this bond right now in the market, the return that bond investors would require from this investment is 2.5%. It is no longer 2%. Okay, very good. So I know what the face value of my debt is. I know what the balance is on my debt. The question is, what is the market value of my debt? So I want to compute the market value of my debt. And for that, I'm just going to enter my little formula, which was over here. So this is the formula that I want to enter. So notice what I need to do here. I need to take my coupon payment and multiply it by this guy over here, and then I need to discount the final payment. So the first thing I'm going to do is I'm going to take B out of this expression. So I'm just going to take it out, and then I'm going to multiply by the rest of the expression after I take B out. So let me do this. Let me take B out. B is the face value of my debt. So here it's 100 million. And then what do I need to multiply it by? So there is first this part. So once I've taken B out, I'm left with R times this guy. And then if I take B out from here, I'll just have to multiply it by 1 over 1 plus R prime power capital T. So let's do this. So I have the first thing that appears is R. So that's the contract rate over here. And then I'm going to multiply it by open parenthesis 1 minus, so instead of writing 1 over 1 plus R prime power T, I'm going to write it like so. I'm going to write 1 plus the contract rate, R prime, and I'm going to raise that to power minus maturity. So what I've written here is 1 over 1 plus R prime power T, but I've just used the standard algebraic rule of turning that into a negative exponent. So I'm going to close my parenthesis, and then all I have to do here is to divide by the market rate. So I've taken care of my coupons, and then of course I get my balance due at the end. So there's that other 1 over 1 plus R prime power capital T, and I'm going to write it more simply at 1 plus R prime power minus maturity. And then I have one parenthesis to close. So again, I want to make it clear that what I just entered here is exactly this formula over here. That's it for a coupon bond. Okay, very good. Let's return here. So let's see what number we get. So we get about $99.5 million. That's a number that makes sense. Why do I say it makes sense? Is because the market rate is above the contract rate. So that's going to imply that the market value of debt is below the face value of debt. So far, so good. Market value of 99.5, that's below 100. That makes sense. Another way to check that my formula is correct is to ask ourselves, what if the market rate was exactly equal to the contract rate? Well, in that case, I would expect face value and market value to be exactly the same. And sure enough, that's the case here. So there's a chance at least that I entered my formula correctly. In fact, I feel so good about my formula now that I'm just going to click that formula to so that it will work all the way down. But I have those not available annoying entries here. So why is this not available? It's because this is a corporation that does not have any debt that is going to mature in 3 years. So let me put a fake number here. It doesn't matter because the corporation doesn't have any of those debts anyway, but I just want to get rid of those NAs so that when I click my way down, everything is going to work out. So now I have the market value, not just of the bond that is going to mature in 1 year, but of all the bonds that this corporation has. And I can therefore take the sum of all my market value, and I find that the market value of this of the corporation's entire debt is this number, as opposed to the face value or the book value of all my debt, which is just the sum of all the face value. And here we see that the market value is slightly below the book value. But this is it. This is the work that you have to do if you want to convert debt from book value to market value. What you want to do is discount all the payments associated with each and every piece of debt that a corporation has at the market rate. Now, here's the problem. In practice, you're never going to have data like this. Never, never. First of all, it is not a corporation, even a public corporation, is not going to tell you about, is not going to make it easy anyway for you to find out about each and every piece of debt that it has. I mean, it would make that information available upon request, but if you look at their financial statements, at best what you're going to have is some rough information on how much debt is going to become available at various maturity. And the corporation may give you some idea of what the contract rate is on all those pieces of debt, but finding out what the market information is for each and every one of those specific bonds is going to be up to you. And if you are not dealing with a very large corporation, there's just no chance that you're going to see debt instruments of every possible maturity traded in the market at a particular point in time sufficiently often that you have good information of what the market rate is. So long story short, in life, you're going to have to deal with the information that you do have. So the information that you do have from the financial statements at least is going to give you an idea of what the average maturity is on the corporation's debt. It's going to give you an idea of what the average interest rate is on the corporation's debt. And finally, since you have the average maturity, you're perhaps going to have a good idea of what debt of that type of maturity for that type of corporation is earning in the market right now. So what people do in practice, therefore, is they take a big shortcut, which is assume that instead of a corporation having all the actual pieces of debt that it has, it only has one piece of debt, and it's going to be a coupon bond, and it's going to be of maturity, which is the average maturity that I can infer from the financial statements. Its interest rate is going to be the average interest rate that I can get from the financial statements, and we're going to compare that to the market rate for that average maturity. So these are a lot of words. How is this done in practice? So in practice, what I've just said is typically you're going to have an idea of what the weighted average contract rate is on a corporation's debt. So what is that WACC in practice? It is the average, like I said, of the contract rates on all the pieces of debt that a corporation has, but it's a weighted average, weighted by the face value of the debt that the corporation has at each maturity. So this is basically saying the average dollar of debt for this particular corporation is being charged an interest rate, which is this WACC here. Likewise, I can do exactly the same calculation for the market rate. I can just say on average, this is the market rate that this corporation would be charged on the type of debt that it has. So either people do this in practice, but more frequently what they do is they use what we call the weighted average remaining maturity, or WARM. And what is WARM? WARM is an average of all the maturities of debt that it has outstanding, where the weight once again is going to be the face value. So here what people are going to do is they're going to say the average maturity of $1 of debt for this particular corporation is 8 years. Let me look at the market for what a bond of this type of rating would earn at an 8-year maturity, and that's what I'm going to use as a proxy for what I would want to use here, which is the weighted average market rate. Okay, so again, those are formulas. So let's put them to work so that we actually understand them. What I said is I need to have an idea of what the average interest rate is on the corporation's debt. I need to have an idea of what the market rate would be for this average debt of the corporation at this particular point in time. And finally, I need to know the weighted average remaining maturity. So taking another quick look at those formulas, what I see here is that this is the sum of the product of every face value and every interest rate. Well, in Excel, that's what we call a sum product. And thankfully, we are sum product specialists, so we know how to do this. So you want to do sum product of all the face values, comma, all the contract rates. So that's the top of the WACC formula, divided by what? The total face value of debt that is outstanding, but I already have that number down here. So that number here tells me that the average interest that I am being charged as a corporation on $1 of debt right now is 3.73%. Okay, next I'm going to do the same for the market rate. So this is just yet again a sum product. It's a sum product of all my face values and this time my market rate, not the contract rate. And I'm going to divide once again by the face value of my entire debt. So those dollars of debts that I have, if I was to put them on the market right now, on average, the market would require 3.92% from my debt. And finally, I need my weighted average remaining maturity, another sum product. So I'm going to do a sum product of all my face values and my maturities divided by the face value of my entire debt. And that number here says it's about 8 years. So that means that the average maturity of $1 of debt for this corporation is 8 years. So what I'm going to do next, and that's the big shortcut, is I'm going to pretend that this corporation only has one piece of debt. The face value of that piece of debt is this number here, the total outstanding debt of the corporation. The maturity of that debt is 8 years. The interest rate on that debt is 3.73%, and the market right now would require 3.92%. 3.92% return from that debt. And with all that, I can calculate the market value of this fictional representative bond that represents the debt of the corporation. And I'm going to apply exactly the same formula as I had before. Namely, I'm going to take my face value, which now is the entire face value of all the debt for this corporation. And then I'm going to multiply by the contract rate, I'm sorry. That's the little r right here, times open parenthesis, 1 minus 1 plus the market rate, which I'm going to use my WAM as the proxy, power minus the maturity, which I'm going to use this average maturity now, since I'm pretending that there's only one piece of debt, and this is going to be divided by the market rate, R prime. So that's the first piece of my calculation, plus now I need to discount the final payment, and that's just going to be discounted by 1 plus market rate power minus the remaining maturity. So what I have done here is applied exactly the same formula we applied to each bond of the corporation before, but instead I'm applying it to this one fictional giant bond that is supposed to represent the entire debt of the corporation. And again, the idea here is that in life, you will have enough information to estimate very closely what the average interest rate is, what the average maturity is, and what the average market rate is for a corporation of this bond rating. You will be able to do this. And therefore, if you are willing to take this shortcut here, you will be able to calculate the market value of these corporations debt in one fell swoop. And here, as you can see, the approximation here is actually excellent. Instead of doing the work of bond by bond, collecting information of what the actual interest rate is and what the market would charge for that specific bond, if I take this giant shortcut, you will find that my approximation for market value is actually pretty good. And this is going to be the case as long as you're not looking at big differences between contract rate and market rate. If those differences become humongous, then unfortunately you will have no choice but to be careful. Okay, so that's it. That's how you go from book value to market value. I will repeat that theory tells you that you want to use market value, not book value. In practice, people use book value most of the time because it's easier and nobody wants to do the work that I just showed you, or maybe people do not have enough information. But in situations where there are big gaps between contract rates and market rates, you should worry about this, and you should actually do that work. Okay, very good. So this is all I wanted to say about WACC estimation in practice. Now let us return to introducing frictions in the Modigliani-Miller model. So you remember last time we introduced taxes, and we discovered that when you introduce taxes, it gives that an advantage, which is the fact that interest rate is tax deductible, and therefore the corporation, by adding more debt, creates more value. So it's no longer the case that the value of the corporation is independent of the capital structure. But of course, that cannot be the end of the story, because if that were true, then we should see every corporation out there take on as much debt as possible, in fact not use any equity at all if such a thing were possible. But that's not what we see, and obviously that's because the calculations we've done so far abstract from a number of issues associated with financial distress. As you take on more debt, you're going to increase the risk of bankruptcy. You're going to increase the risk that the corporation is not going to be able to meet its debt payments. And when that happens, all kinds of bad things are going to happen. And as a result, the optimal debt to value ratio is going to be less than 100%. So this is something we saw on homework number 5, for instance, and something we did also the other day. So if I go to my answer key to homework number 5, which I already sent you, in that answer key, if we look at the case with taxes and we plot debt versus, say, the value of the corporation when I add bankruptcy costs, I'm going to get charts that look something like this, right? So initially, that is good because you get this tax break and the possibility of bankruptcy is remote, but eventually the possibility of bankruptcy becomes real, and that starts having adverse effects. At this point in the homework, all we did is we just use some specific functional form for the adverse consequences of that. What we're going to do starting with video number 7 is we're going to get serious about why is it specifically that bankruptcy is bad for firm value, and we're going to go beyond the obvious here. Okay, very good. By the way, to tie up a loose end. The other day I was not able to use my solver properly, and I told you that if you wanted to solve for the optimal capital structure of the corporation, you could use the solver. So let's do this quickly here. This table gives me a relationship between debt and the value of the corporation with bankruptcy. So obviously what I can do is use my little solver. Let's hope that it's going to work today. And what do I want to do? I want to maximize the value of the corporation given that there are bankruptcy costs by changing, say, the quantity of debt, which is this guy, and I want to launch it, and I want to solve it, and I want to accept the answer. And it is telling me that the optimal quantity of debt in this case is 300. That corresponds to a debt to equity ratio of 0.71, and that makes the value of the corporation as high as it can possibly be. So what we did just there, just to look at a chart that represents what we did, is we asked, what is the optimal quantity of debt? So here I'm plotting things slightly differently. Instead of plotting debt directly or debt over equity, I'm plotting debt over the value of the corporation, which is the market value of debt and the market value of equity, but the same relationship as the one we just drew is going to prevail. It's going to be hill-shaped like this. Why? Because, just to repeat, debt initially is going to have positive consequences. There's the debt tax shield, and in video number 7, we'll discuss another important positive consequence of debt, at least initially. And then eventually, as the possibility of bankruptcy becomes closer, a higher and a higher probability event, we start getting into all kinds of problems that we will discuss in more details in video number 7. So, but if it looks hill-shaped like this, obviously there is a top of the hill. The top of the hill here is the capital structure, the leverage ratio that makes the value of the corporation as high as it can possibly be. And this right here is what we call the optimal capital structure. The optimal capital structure is the leverage ratio that makes the value of the corporation as high as possible. And the trade-off, this basic trade-off theory that is good initially, but eventually you start running into problems that more than offset the benefits of debt, whatever they are, it makes a very, very sharp prediction. That sharp prediction is that there should be a target leverage ratio, a target capital structure for corporations. So to me, the first time I saw this, I have to say, it felt hopelessly naive. It's a very simplistic theory in some ways, and the very idea that corporations out there had targets in their mind that they try to stay around and stay near, that seemed to be, frankly, a little bit crazy. So the one question to ask is, when we look at data, does it appear that corporations have leverage or capital structure targets? So for instance here, let's look at the leverage ratio. So this is the debt to value ratio of a corporation of IBM, to be specific, and we're going to download those data in a moment. And when you look at those charts, it does, in fact, look like firms have something like a target capital structure. So what do I mean by this? What is it about those data that leads me to say that yes, IBM appears to have a happy place in terms of leverage ratio? So what you see here is that this data here, the average, the leverage ratio of IBM in time seems to hover around a particular level. So I don't know what that level is, somewhere between 0.15 and 0.20. So yes, I see IBM stray away from that leverage ratio, but when it does so, and it may stay away for a little while, it has a tendency to come back. In other words, it has a tendency to revert to the mean. So the leverage ratio of IBM appears to live around a particular long-term level. There are exceptions. For instance, here I see something happening in the 90s, and I certainly see something that looks once again like a drift recently, and we'll talk about that. But by and large, the idea that IBM likes to be around a particular level and that it tends to hover around that level doesn't seem so crazy. But so far, we're just staring at data and making qualitative statements. How would we go about testing the proposition that a firm like IBM does have a tendency to live around a target, say a D over V star, where it likes to be? Well, what it means, what it should mean, in the simplest possible way, is if in a particular quarter, in a particular time period, I am away from my desired targets, then I should have a tendency to return to that target. Of course, I expect leverage to have momentum. If I have at a particular leverage ratio right now, it's because I have all those bonds on my books, I'm not going to be able to to change that on a dime. Changing that leverage ratio is either going to mean issuing new bonds or is going to mean retiring all bonds, which takes time. So I do expect the recent past, to have a consequence on my current leverage ratio. But at the same time, I expect to return towards what my long-term target is if we believe the trade-off theory. So here, what this model is saying is that the leverage ratio in a particular period should be a weighted average of where I was in the most recent period. That's where I was, and where I was has momentum, and where I want to be. So gamma here, this parameter, is going to be the weight that I put in my target, whereas 1 minus gamma is going to be the weight of momentum. So to the extent, another way to say this, that D over V is away from my target, gamma is going to tell me the speed at which I'm going to return to my target. And then, of course, there's going to be some randomness. There are going to be other factors, luck, maybe in one particular quarter, for whatever reason, I was not able to issue debt as fast as I wanted to. So there's going to be all kinds of factors that are going to enter into this proposition. So then what would it mean that a corporation has a tendency to gravitate around and towards a long-term target? It will mean that gamma is some number between 0, strictly between 0 and 1, right? Because for instance, if gamma was 0, what would it mean? It would mean that my leverage ratio today is just, so this term here would be 1, this term would be 0, so my leverage ratio today would just be whatever it was last period plus some noise. So this would be what we call a random walk. If gamma were 0, the leverage ratio would follow a random walk. It would have no direction, no tendency to return to some particular target. It would just be whatever it was most recently plus some random shocks, and it could drift in all kinds of direction. If instead gamma is a number bigger than 0, and in particular between 0 and 1, then I'm going to have that tendency to return towards some long-term target. So the specific proposition here that we want to test is gamma in fact a number between 0 and 1, which suggests that IBM has a tendency to return towards some long-term target. So let's put this to the test. Let's go get some IBM data and let's estimate what gamma is. So for simplicity, I already put my IBM data right here on my webpage. It's called historical IBM data. Let me download it. So I'm going to open it and I'm going to make it nice and big. Very good. So what we have here is for IBM. Let me make the date a little bit bigger so I can read it. This is since from 1994 to today. I'm going to have all their liabilities. I have short-term debt, long-term debt. This is preferred equity, which for this purpose we're going to treat as debt. As you will see, it does not matter because IBM does not have much preferred equity. In fact, it does not have any preferred equity anymore. And this is the market value of its equity. So for instance, if I want to calculate the value of the corporation, it is the sum of all those liabilities. So it's going to be the sum of all my debt and all my equity. So this is the market value in millions of IBM in the first quarter of 1994. So this is V. And if I look at all my liabilities, including preferred equity divided by this value, is just going to be the sum of my short-term debt, my long-term debt, my preferred, divided by the value of the corporation. And let me do another little trick here, which I'm going to put my date right next to those number. And so those date formats here, so this is data that I downloaded from FactSet, and the date formats that they use are just not very good. So let me instead use something that is more useful. I'm going to write, this is a trick that I learned from a research assistant at the Fed a long time ago. And the thing about tricks is it is the simplest tricks that make your life, that really improve your life. And this one is, this is what she told me. She said for the first quarter, you just write the date as 12 and a half, which is the half of a quarter. And then for the next date, you just take the previous date and you add a quarter. And now you're going to have a date marker, which is going to be very Excel friendly, as you will see in a moment, as opposed to whatever that date format is, which nobody can read to save their life. So anyway, that's a good trick that you may want to remember. Simple as it is, I've used it so often, I can tell you it's a good trick. Anyway, we're going to click all those data, which means now that, for instance, one thing that I can do, that's the sense in which it's very Excel friendly, is plot my leverage ratio against my date, and I'm going to insert a scatter. And what we see here is exactly the chart that you saw on my PowerPoint. This is IBM's leverage ratio, which we just computed. And again, I look at those data and what I see is a long-term tendency to return to long-term average. And the formalization of this is what you see on my slide here, which is today's leverage ratio is a weighted average of the most recent past, and my long-term target together with some shock. Econometrically, statistically speaking, this model here has a name. This is called an AR1 model of the leverage ratio, an autoregressive model of order 1. Why? Because this is a regression, just like a CAPM regression, the likes of which we run in chapter number 2. What am I regressing on what? Well, my Y variable is my leverage ratio today. My X variable is my leverage ratio yesterday. This here, this gamma times d over v star is just going to be the constant in my regression. And this is the error term that we always have in a regression. And remember that my goal is going to be estimating gamma and asking whether or not gamma is between 0 and 1. But gamma here, the coefficient that I'm going to get in my regression in front of d over vt is going to be 1 minus gamma. So if I have an estimate for 1 minus gamma, I also have an estimate for gamma. Okay, so what do I need? I need a y variable, which is, say, today. Let's say that's today's leverage ratio. And I need an x variable, which is yesterday. So let's do it. Let's go back to my data. So if this is today, now I need to write last quarter. And this is something in econometrics that we call a lag variable. So this, I'm just going to look at the lagged leverage ratio, which all this means is last quarter leverage ratio. So for instance, here in the first quarter of 1994, I don't have enough data. I do not know what the last quarter would be. But starting in this second period, I know that the last quarter leverage ratio was this guy. So there we go. So this is going to be my Y variable in my regression. That's today or this quarter. This is going to be my X variable. This is yesterday or the most recent quarter. And so now all I have to do is to run a regression. And for that, I'm going to data analysis regression, just like we did in chapter number 2. What is my Y range? My Y range is going to be this quarter. So I cannot use the first quarter because I don't know what the previous quarter was in the first quarter. So I have to start with the second quarter. So I'm taking all my data. What is my X range? So it is my entire last quarter data. I do not have any labels in this particular case, and I just want to output my regression, and I'm going to put it over here. And there we go. This is my regression output. And all I want from my regression output is the intercept and the coefficient of the regression. So let me go back to my slide. The intercept is gamma times d over v star, right? That's the intercept in this regression. That's the constant. And the coefficient in front of the lagged quarter, the most recent quarter, is 1 minus gamma. So let me make sure that I remember what it is that my regression is giving me. This guy is just gamma d over v star. So that's the constant in this regression. And then this one here is 1 minus gamma. All right, very good. So now I've estimated 1 minus gamma, which is telling me that gamma is equal, if 1 minus gamma is equal to 0.96, gamma is equal to 1 to 1 minus 0.86, which is around 13%. So I think my slide here says that IBM's gamma estimates to 14%. So somehow we must be using slightly different data. It doesn't matter. It's 13%, not 14%. So how to think about this 13% that I got? How to think about 13% is I put 13% on my long-term target, and the rest 86% on wherever my leverage ratio was most recently. Another way to say this is that 14% of the gap between where I am today and where I want to be, which is my optimal capital structure, 14% or 13%, I'm sorry, of that gap is erased every quarter. Okay, so that's the way to think about this 13%. As I said, as long as this gamma is statistically different from zero, I do in fact have evidence that IBM has a tendency to return to a long-term leverage ratio. But what does it mean that gamma is bigger than zero? Saying that gamma is bigger than zero is saying that 1 minus gamma is less than 1. Right? Gamma being bigger than zero means that 1 minus gamma is less than 1. And now to make this easy from a statistical point of view, even though I told you that I do not like confidence intervals, I am going to look here at confidence intervals. And those confidence intervals here are telling me that 95% of the time, this particular interval here between 0.81 and 0.92, 95% of the time it contains the true gamma. Okay, 95% of the time it contains the true gamma. Well, you know what number is not in this interval? 1. So I am, to speak loosely, 95% confident that 1 minus gamma, this coefficient, is not 1. I can reject the hypothesis that 1 minus gamma is 1, which is rejecting the hypothesis that gamma is 0. So that this guy here, this 13%, is actually statistically significantly different from 0. I am 95% confident that it is not 0. I can reject the hypothesis that it is 0 with 95% confidence. In other words, I have high statistical incredible statistical evidence that IBM has a tendency to return towards a target, which invites the question, what is that target? So what I need is D over V star. But luckily, my constant here is an estimate of gamma times D over V star. And now I have an estimate of gamma. So I can just take my constant, 0.02, and divide it by my estimate of gamma, and this is in turn going to give me an estimate of IBM's target leverage ratio. And the estimate target leverage ratio of IBM, according to all the data that I have, is about 17%. And that makes sense, right? Because if I look at IBM's raw data, 17% is right here. What my regression is telling me is that yes, IBM has a tendency to return to a long-term value of about 17% for its leverage ratio. And that tendency can be measured quite precisely. 13% of the gap between wherever IBM is at a particular point in time and where it wants to be, which is 17%, 13% of that gap is erased every quarter. That's the tendency that IBM has to return to that long-term target. Okay, very good. So this is direct evidence that the trade-off theory actually is not that insane. I mean, and by the way, you can do this for corporation after corporation after corporation. It will always look, the data will always look like this, like it has a tendency to return to a long-term mean. So that prediction actually of all predictions in finance is that supports data tests quite well. Now, of course, we should be a little bit more careful. The fact is that the idea that IBM has one leverage target is just intuitively unbelievable, because market conditions are going to change, market fundamentals are going to change, IBM's fundamentals are going to change. So in fact, that target must move around a little bit around time. And so this gives rise to a more evolved version of the trade-off theory, which is called the dynamic trade-off theory, which here I'm citing a couple papers that have tested that theory. And all you do here is you basically add to this regression fundamentals other than this constant and the most recent leverage ratio. So what would be an example of one such fundamentals? One would be the level of interest rates. And let me show you why. So you can see this is something we've already talked about. This is this tendency that IBM and just about every large corporation in the United States, this tendency that they've had to take on more debt over the past few years, and in particular over the past 10 years. Why have they done this? Because debt is cheap. Interest rates have kept falling, and they've kept and now they've reached levels that we've never seen before. Put another way, appetite for the debt issued by large US corporations has never been as high as it is today. And therefore, it is natural that we would see a drift in IBM's leverage ratio. Well, this is evidence in favor of a dynamic trade-off theory. In other words, a notion that IBM is not just targeting a long-term, a constant long-term target like this, but its leverage ratio is also affected to some extent by current market conditions. And again, if you want to know more about those things, I encourage you to read those papers. But this is all I had to say about the trade-off theory for now, and I'm going to stop my video until next time. And next time we will get a little bit more serious about what happens when you take on more debt. What are the actual frictions that cause debt to be not so good after all past a certain level?